day friends. In the subject of personal financial planning, in this lecture I will be talking about the tax planning. And for tax planning I had given another lecture on which I had explained about the tax structure in this country, the direct tax and the indirect tax, the income tax and the capital gain tax. Why we are talking of this tax? Because while you are making your personal financial planning, understanding the tax system of the country and making plan as per your tax requirement, as per your tax liability is very important. If you make your tax planning properly, you will able to minimize your tax liability within the legal means, and thereby you will able to make good financial planning. So for making good financial planning, it is important to understand the tax system of the country so that you can plan accordingly. So in my previous lecture, I was talking about the income tax and the capital gain tax. In this lecture, I will be talking about when you consider the capital gain tax as a short-term capital gain tax, the long-term capital gain tax, and the different income tax slabs, so that you can understand that how much is your tax liability. See, when you are making your plans, suppose my income is say 1 lakh rupees per month. So while making my financial plan, I must know how much is my tax liability out of the annual income of my 12 lakh rupees, how much I will have to pay tax. And by proper financial planning, for proper tax planning, I can reduce my tax liability, and this money which I am able to save for paying, which I am not paying tax, right, it will become my saving also. I will be talking that thing in detail. It will become my saving, and then it is also being invested. Since this investment will give me some income. So the basic purpose of the personal financial planning is so that you can manage your finance properly. So for managing your finance properly, managing your tax responsibility, tax liability is also very important. So for understanding that tax system in the tax liability, you must understand the different type of taxes that an individual or that an HUF or anybody who has to pay, right, the person has to pay, so that we can plan it accordingly. Now coming to the capital gain tax, which I was talking earlier in my previous lecture also, right. So in my previous lecture I referred about what is capital gain tax and categorize the capital gain tax in two categories, that is short term and the long term. So when it will be considered as a short term capital gain, when it will be considered as a long term capital gain, depending on the time period for you which you hold that asset. For example, equity shares, you have invested in stocks, shares of the companies. So if you are holding the share for less than 12 months or less than 12 months and dispose it off, it will be considered as short term capital gain. Suppose I bought a share worth 50,000 rupees of a company, and after 10 months, after 11 months, before the 12 months or 12 months before the 12 months, I dispose it off from 50,000 rupees purchase price to 60,000 rupees is my sale price. So this 10,000 rupees is the capital gain, which will be considered as a short term capital gain, because I am holding this share only for less than 12 months. If I held these shares for more than 12 months, it will be considered as long term capital gain. Anyway, so if you equity stocks sold within 12 months of the purchase, it will be considered as a short term. Debt mutual funds units sold within 36 months of the purchase, whether it is equity shares or equity mutual fund, one same thing. Similarly, whether you are holding debenture bonds or whether you are holding debt mutual funds is the same thing, means it categorized for the capital gain purposes, it is being categorized in the same category. So for debt mutual funds or debts, bonds, right, debentures, if you dispose it off, you sell your bonds, you sell your shares, you sell your debt mutual funds within 36 months of the purchase, it will be considered as short term capital gain. When I am using the word capital gain, it can be loss also. If you are buying bonds worth 1 lakh rupees and within 36 months you sell it for say 97,000 rupees. So 3,000 rupees loss which you have incurred is your short-term capital loss. Similarly, real estate property or gold sold within 36 months of the purchase. The way we treat the bonds or debentures or debt mutual funds, in the same manner we also treated real estate or gold, right? So if the gold is being sold, if the real estate is being sold within 36 months, it will be categorized as short-term capital gain or loss. If you held these assets beyond these limits which I have just explained, for equity, if you are holding the equity shares for more than 12 months and then selling it, it will be considered as the long-term capital gain. If you are holding debt mutual funds or debt bonds, if you are holding real estate, if you are holding gold for more than 36 months and then dispose it off, it will be considered as the long-term capital gain or long-term capital loss. Why I am saying so? Because it is not necessary that when you dispose of that asset, you always make profit. You may incur loss also, right? So that is called short-term capital gain or short-term loss, and long-term capital gain, long-term loss. So if the assets is sold after the specified period, which I have just explained, 12 months and 36 months, the gain or losses will become long-term capital gain or losses. Depending on the type of asset you gain, may receive indexation benefit of long-term capital gains. See, one benefit of this is that supposing we are holding the debt mutual fund, right? So you not only you are getting the benefit of paying the capital gain tax of if you keep these hold, if you hold these index funds, debt mutual funds beyond 36 months, but you also get the benefit of indexation. Indexation under the Income Tax Act, for the increase in the price level for inflation, the indexation is being made. There is a specific procedure, I am not explaining here how we do indexation, but indexation is on the basis of the rise in the price, means the price index. Because say for example, just to understand for how indexing takes place, I have purchased a bond or bought debt fund of 100 rupees, debt mutual fund for 100 rupees. After 5 years, I am disposing it off for say 125 rupees. So if the indexation benefit is not there, the gain will be considered as 25 rupees. But what we do is, what the Income Tax Authority allows you is to have the benefit of indexation, because in the 5-year period, the value of this 100 rupee is not same 100 rupee. Because of the inflation, the value has decreased. So 100 rupees, there is an indexation formula by which this 100 will be considered, say for example 110. So your cost price will be considered as not 100, your cost price will be considered as the 110, right? So with indexation, your purchase price will be not 100 but 110. So selling price minus 110, that will be the capital gain that will be considered. So anyway, what I am trying to say by this is that when you sell assets after a long period, in a long-term capital gain, you also get the benefit of indexation. So apart from this capital gain tax, apart from this income tax, there is another direct tax which is called corporate tax. It is like income tax on individuals. On corporates or companies, the tax that is being imposed, the income tax that is being imposed is called corporate tax. So on individuals we call it income tax, on companies we call it corporate tax. So the corporate tax applies to the businesses and entities filing the return as a company. This is a slab rate depending on the turnover of the firm. Depending on different turnover, whatever is your level of turnover, on the base of that, the corporate tax slab is decided. Now, after coming to the different types of direct tax, that is income tax, the corporate tax and the capital gain tax, why there is a need of tax planning? We must understand that why the tax planning is important, how you make the tax planning. So, what are the reasons of making tax planning? So, tax payments are compulsory for all individuals who fall under the income tax bracket. Income tax bracket means if your income is taxable. So, nowadays tax planning is must to reduce tax liability by investing in different investment schemes as prescribed by the Income Tax Act. Why I am saying so? Because our ultimate goal is we are studying the subject of the financial planning. So, under the personal financial planning is a very important, as I said in the beginning of my lecture, the tax planning is an integral part of the financial planning, right? So, you must understand that what are the different schemes, what are the different acts of the Government Income Tax Act under which you can save the tax. So, with tax planning, one will be able to make her tax payments such that he or she will receive considerable returns over a specified period of time involving minimum risk, right? So, with minimum risk, you can enhance your income and also you reduce your tax liability. So, also effective tax planning will help in reducing a person's tax liability. To minimize litigation, if you are making proper tax planning, you will not be subject to litigation with the income tax authorities. It is a convenient for both, not only for the taxpayer but also the agencies which imposes the tax. So, to litigate is to resolve tax disputes with local, federal, state or foreign tax authorities. Suppose I feel that I am not supposed to pay this tax. The government feels, the income tax authorities feels this individual has to pay this tax. What will happen? It will lead to litigation, right? So, if we are making good tax planning, if you are making proper tax planning, systematic tax planning, this litigation will be minimized. So, there is often friction between tax collector and taxpayer, as the former attempts, means the tax collector attempts to extract the maximum amount possible, while the later desires to keep their tax liability to a minimum. Means the taxpayer would like that the tax liability is being minimized, the collector would like that the individual should be pay more and more tax. So, minimizing litigation save the taxpayers from legal liability. If you are making proper planning, if you are making good tax planning, so you will be able to minimize the tax litigation. To reduce tax liability, this I have already explained many times that ultimately by proper planning we will be able to reduce the liability. So, every taxpayer wishes to reduce their tax burden and save money for their future. You can reduce your payable tax by arranging your investments within the various benefits offered under the Income Tax Act 1961. I will be explaining these benefits later on. There are certain investments, if you make these investment, your taxable liability will get reduced, right? At this moment I am telling this much, I will explaining in detail all these things. So, the Act offers many tax planning investment schemes that can significantly reduce your tax liability. Means if you are making proper planning, your tax liability can be minimized. Ensure economic stability. If each one of us pay proper tax through proper planning, the Government of India will get maximum revenue, and thereby this revenue, this taxes will be utilized for the development of the country. So, taxpayers' money is devoted to the betterment of the country. Effective tax planning and management provide a healthy inflow of white money that results in the sound progress of the economy. This benefits both the citizens and the economy. Means it is good for both, I mean for taxpayer as well as the government agencies, as well as the government, right? So, there will be economic stability if individuals pay their tax properly as per the law of the land through proper tax planning. There will be economic stability. Government knows in advance how much tax they will able to collect, and you also know how much tax you have to pay. So, it will lead to the economic stability. To leverage productivity, one of the core tax planning objective is channelizing funds from taxable sources to different income generating plans. This ensures optimal utilization of fund for productive causes. See, whatever the tax funds you pay, if that tax is being properly productively channelized, it is being used for infrastructure purposes, it is being used for administrative purposes, right? So, that money that you are paying, that will, if it is being channelized properly, so there will be a productive use of the money, and that will be beneficial for you and for the government both in the long run. So, now after talking of the benefits of the tax planning, let me very briefly talk about the different types of tax planning, what are the and this is not only from the individual's point of view, this is also from the corporate point of view. Supposing you're an individual who will be running a company, who will be running a business organization, right? So through in the business also you have to make proper tax planning. So basically my focus will be here on the individuals. So short range tax planning, now there are different types of tax planning. One is called short range tax planning. Under this method, the tax planning is through it and executed, thought of it and executed at the end of the fiscal year. Fiscal year means after the end of the financial year. Investors resort to this planning in an attempt to search for ways to limit their tax liability legally when the financial year comes to an end. Friends, in the previous lecture of mine on this tax planning, I had explained you the difference between tax assessment year and the financial year. So once the financial year is over and the assessment year starts, then for that assessment year, the individuals make their plans so that they can minimize their tax planning. And in brief, I would say the short-run tax planning is the planning for tax for a year or so. So this method does not partake long-term commitments. However, it can still promote substantial tax saving. Means tax planning which you make for a year, your current year or for the current year in the next assessment year, that is called short range planning. Then the other is called long-term tax planning. As the word indicates, it is a planning for more than a year, normally for a longer period of time, 3 years, 5 years. This plan is chalked out at the beginning of the fiscal and the taxpayer follows this plan throughout the year. Unlike short range tax planning, you might not be offered with immediate tax benefit, but it can be proved useful in the long term. Just to give you an example, you are getting your house constructed, right? And for that purpose, you become a member of a housing society on which you are paying installments, right? So, and for the payment of installments, you have borrowed money from the bank. You have taken housing loan. So as soon as you get the completion of the house, completion certificate, from that period up to a period of time, whatever the interest you will be paying on that loan which you have borrowed for the purpose of constructing your house, it will be, tax authorities will give you tax exemption for that, right? So that is basically a long-term planning. When I am getting a housing loan for my housing purposes, right, I am planning that by taking this loan, I will able to reduce my tax liability in future, right? So this is an example of long-term tax planning, and just only in one example, there can be hundreds of such examples, right? So permissive tax planning, the other type of planning is called permissive tax planning. This method involves planning under various provisions of the Indian taxation laws. Tax planning in India offers several provisions such as deductions, exemptions. I'll be explaining all these, what is deduction, what is exemption, deductions, exemptions, contributions and incentives. For example, Section 80C of the Income Tax Act 1961 offers several types of deductions on various tax saving instruments. Just to give you one or two examples here at this moment itself, like say for example, if you are paying your insurance premium, right, up to 1.5 lakh rupees, there are certain expenses, there are certain investments which you make that is being deducted from your total income, right? You are depositing money in your provident fund account. So the contribution which you are making to your PF account, right, that is not only give you a good savings, that is not only a good investment on which you will earn 7%, 7.1%, right, but also your tax liability will be reduced by making investment in your provident fund account. The expenses which you are paying on your 2 children's education, that is also being considered as a deduction under Section 80C. So there are certain type of expenses and the investments. If you make such investments, your tax liability will get reduced and it will be deducted from your total income. And under Section 80C, up to 1.5 lakh rupees, the contribution up to 1.5 lakh rupees under various heads will be deducted from your total income. What I am saying is, suppose my income is 10 lakh rupees per annum, and if I contribute to my PF account, my LIC fund, and up to and my two child's education up to 1.5 lakh rupees, this investment and expenses will be reduced, will be deducted from my total income, that is 10 lakh minus 1.5 lakh. So my taxable income will be considered as not 10 lakh, will be considered as 8.5 lakh rupees, right? So there are certain deductions which are being allowed. There are deductions, exemptions, contributions, incentives. So means these are called permissive tax planning. If you make proper tax planning which are permissible, certain deductions are permissible, certain exemptions are there. Like say for example, agriculture income up to a particular limit, that is exempted from your income, right? So this is called permissible tax planning. Similarly, purposive tax planning. Purposive tax planning means you make the tax planning for a particular purpose. Purposive tax planning involves using tax saver instruments with a specific purpose in mind. This ensures that you obtain optimal benefits from your investments. This includes accurately selecting the appropriate investments, creating an apt agenda to replace assets if required, and diversification of business and income assets based on your residential status. See, especially I would say for a businessman, for business class people, right, those who are in the businesses, in your business, if you make certain investment that is being exempted from calculating of your income tax. Suppose a certain sum of money you are spending on research and development in your business, R&D. So that expenditure up to a particular threshold limit, that expenditure which you incur on your research and development expenses, right, that is being reduced from your income, and then your income tax liability will get reduced. So it is called purposive tax planning for a particular purpose. Suppose the profit which you earn, and this profit is being reinvested in certain basic industry or certain basic machinery or certain investment which are being allowed by the government of India for tax purposes, then that income will get reduced for taxable purposes. That is called purposive tax planning. Now, after talking of different type of tax planning, just in a brief for a reference purpose, I would say scope of tax planning. This scope of tax planning depends on various aspects. I am just referring to these things. It depends on the location of the business. Suppose there are certain areas, if you locate your business, your tax liability will get reduced. Say for example, government want that there should be a balance. Just to give you an example, government wants that there should be a balanced development of the country. All regions of the country should develop. There are certain regions which are still not so developed, or if I call them backward, and government want that industry should be promoted in that region. For promoting industry in that region, government exempt up to a particular number of years the income that is being earned in that region. So it depends on the tax planning, depends on your location of the business, it depends on nature and size of the business, forms of business organization and pattern of its ownership. When I am saying forms of business organization means whether it is sole proprietorship, partnership, limited liability partnership, private limited company, right? So what is the pattern of ownership? Is specific management decisions like make or buy, own or lease, capital structure, renew or replace, etc. Employees remuneration, right, and mergers, amalgamation of the company. So there are various aspects on the base of this. Your tax planning depends. Double taxation relief, non-residential and advance ruling, so on and so forth. So after talking of this, let me talk of briefly limitations of tax planning, right? So when an assessee has not claimed exemptions, deductions or relief, when I am saying has not claimed means you was entitled to claim, but you have not claimed because of the unknown, you are not knowing it or because of any reason. So when an assessee has not claimed exemption, deduction or relief to which you are entitled, before the assessment is completed, he is not allowed to claim it as rectification of mistake or an appeal or revision. You have not applied for, you have not claimed and exempted, and the assessment, the assessment has not been is completed, then unless you apply it, you will not be eligible for that. Automatically you will not be eligible. Other economic factors, other direct tax laws apart from the Income Tax Act and other economic laws have to be considered before making any decision in respect of reducing tax liability. See, when you want to make a tax liability, you want to reduce your tax liability, you want to plan your tax right, you have to keep in mind not only the provisions that are applicable in the Income Tax Act, but also the other provisions of the land, so that you can be really, means there are certain other conditions which are to be fulfilled for getting a tax exemption. You must know all these conditions and you must fulfill those conditions. So this puts a limitation on the scope of tax planning. Sometimes a decision taken for tax advantage leads a favor to some of the family members at the cost of others, especially in the HUF and other things, in the gift tax case, in terms of individual property or income rights. This may cause irritation and imbalances in the family. Hence, social, moral and psychological implications force not to go beyond a certain level of tax reduction. Means within the law you can minimize the tax liability of one individual or two individual, but because keeping in mind the fabric of the family, because of what the other members, what will be the impact on the other members, so for that very reason, psychological reasons and other implications, the tax benefit is not being accrued to one or two individuals of the family. Direct tax laws are amended frequently either by the Direct Tax Laws Act or by the Finance Act. Right? Finance Act means each year when the budget is being presented by the Finance Minister, the Finance Act is being presented. So thus puts a hindrance in making long-term planning. Since in India every year the finance budget is being presented and the direct tax laws also changes, I will not say very frequently, but it do changes, and the Finance Act also changes. So because of this change in the laws, the provisions, it makes an implication if you want to make a long-term planning. So sometime it makes a hindrance in the long-term planning, because whatever the law that the government makes, it doesn't mean that it cannot be changed. Today you are making a tax planning, keeping in mind the present laws of the country. But suppose after 2 years, after 1 year, after 3 years, right, that tax laws changes, then obviously that planning which you had made, keeping in mind the previous laws, will not be applicable. So these are certain limitations of the tax planning. Anyway, friends, so in my next lecture, I'll be talking about tax slabs and different type of incomes. So this is from my side about why I'm saying so. You may be thinking in the personal financial planning why we are talking of this tax system, because understanding the tax system is very important for your personal financial planning, so that you can manage your finance, you can manage your tax liability in a systematical manner, and you can make your investment in a manner so that which is beneficial for you in the long run. Thank you very much.